Hello everyone, I'm Steve Savant, syndicated financial columnist and money color commentator. On today's show, active money management with ETFs, part 4 of our series on building a firm financial foundation for retirement with financial advisor Sean Humiston. Welcome to the show, Sean.
Thank you.
Sean, I know that you have a partner that you outsource all your securities to because this is all they do.
That's right.
I mean, this is all. I mean, these guys, they do not do financial planning at large, so to speak. They're really security guys. They do mutual funds, ETFs, maybe REITs. They're into stocks and bond trades. But predominantly what they do for you is for your clients for ETFs. Now, it's always a yin and yang argument here. Why am I looking at ETFs over mutual funds? It's not that there's a wrong or right here, but there's a preference here. Talk about it.
Yeah, so let's first just, what I see as far as a vision on the differences between those financial advisors or those money managers. We always look at the active guys versus the passive guys. So your passive guys are going to be your, let's set up some mutual funds and sort of just turn it off and forget about it. If the market goes up, great, you make money. If the market goes down, oh well, you lose. Whereas an active money manager is more or less really looking at it on a constant basis and making adjustments to those securities as it needs to be based on what's relevant in the economy. Okay, so I think it's a really big difference there.
Let me stop you there though. Okay, if I have a guy managing my account for mutual funds and he's not actively involved, should I be paying him a point to manage my account?
That's a good question.
I mean, think about I think I should be paying for active management, not for somebody saying set it and forget it. You know what I mean?
Right.
This isn't Ronco Securities, right? So so that's the first thing. I don't mind paying for active management if it's truly active. Now, in this case, the gentlemen that these guys that you outsource to are predominantly ETF people. Now, why is that?
Well, we think that obviously with mutual funds, you're going to get expense loads and things that are a little bit on the higher side than you would with an ETF, an exchange traded fund. And naturally, you have a lot more movement, and you can trade quicker than you would
throughout the day.
Yeah, exactly.
So when I'm looking at ETFs, I'm looking at the expense loads, and I have looked at this, looking at Morningstar and measuring up between the differences between the same mutual fund and the same goal. Maybe it's a large cap, small cap, or going to the indices that ETFs are into. When I'm looking at index, it's pretty cheap. I mean, it's pretty cheap to get into. If you don't know what you're doing and you wanted to enter as the poor man's portfolio, S&P 500 is about the best way to go.
Right.
And when I'm looking at those numbers at ETFs, talk about cheap. Those are cheap.
Yeah.
So you're talking about 500 companies that you know about. Most people watch the news. They see the S&P basic results at the end of the day. They can even see the VIX report. We even have an index that talks about the VIX report, which actually quantifies the S&P. Is it a danger zone? Is it kind of okay? It's kind of a futuristic look at the S&P 500. So when I'm looking at ETFs, a client's going to look at that and say, I like the cheap issue. I like that. I like the inexpensive. I like active management. I like guys that are overseeing this. I don't mind paying a point if they're actually doing it.
Right.
Now, when I'm looking at this for ETFs, when do I start thinking as a client? I'm just trying to be the client now. When I'm a young man, I want to be able to all over this, ETFs, maybe some mutual funds, depending upon. I want to be in equities. I got a long time to go. The markets always seem to go up all its life. I still want to take a risk tolerance test. I don't trust, the person I'm sitting across from. What if that person's 40 years old, but he just does not have a propensity for risk? I can't put him in the market. I mean, even though I want to, even though I keep trying to tell him, you will be okay in the long haul. But a lot of people are looking at taking a risk tolerance test. I think you need to be taking this on an annual basis. Things change in your life. And in 2008, I saw people that never did a risk tolerance test. And after 2008's market meltdown, people were all over it.
Right.
So when I'm looking at ETFs, they still have the same risks, mutual funds. They're still in the market, still have things to worry about. But when do I start thinking about, hey, I'm pretty good about doing ETFs all the way up and through into some place up to maybe even up into my upper 50s, early 60s. But then I got to start thinking about moving away. I notice you like to take money off the table. Hey, we're profitable. Talk a little bit about when's that transition from I'm all over ETFs and active management, and then I'll start saying, I need to start preserving some of this.
Yeah, so that strategy is obviously different for everybody. But in general, when you have the ability for growth, and you're able to take that growth and just take it off the table and move it over and put it into more of a guaranteed position, that's only going to increase the better opportunities for retirement, right? The more income and the more assets that you can have in retirement.
I was looking at the yin and the yang on Morningstar. They were talking about the low portfolio turnover provides a higher tax efficiency. It's also talking about their automatic dividend reinvestment, or on the statement. I don't know, maybe it's saying, hey, just give me the profit every year. They're just reinvesting it and letting it roll. Are these good funds for retirement, qualified plans? I mean, this is the kind of thing you should look at. This is a qualified,
ETFs?
yeah, ETFs.
Oh, yeah. Yeah, again, because of that lower expense, I really think that when you look back, 50, 60 years, the mutual fund, the term mutual fund was really where it was at, right? Well diversified, you don't have all your eggs in one basket. Well, now, here we are, 2017. The argument is that ETFs are really what is taking over, right, from a cost-effective way and just more flexibility.
I have to say, in my 35 years of being in this business, I have seen the cost of mutual funds continue to go down. They're still not down enough for most clients. But ETFs kind of were born out of that thinking, hey, let's try to build it around an indice. Let's try to build it around an idea that's low cost for the client. And I think ETFs could, I don't want to get too far ahead of my iShare thinking here, but they could be the play for equities for the foreseeable future. I don't know if I don't see anything on the horizon that's going to probably supplant it.
Right.
So when I'm looking at this, I like the ETF and I like active management. Now, when you outsource this, how do you identify a person? Hey, this guy's got plenty of time. He's got a good risk tolerance threshold here. I'm sending him over because you outsource this.
Right.
How do you identify people like that?
Well, I think the first thing we look at is whether or not they do have that risk tolerance, and if they're already in the market before, right, as of current. So when we first meet with them, they establish that strategy, and then talk with them some more about what they're really trying to accomplish. What are the end games here? Are they looking for inflation protection? Are they looking for growth? Or are they looking for future income? And so some of that, of course, will be right up the ETF world, and then, of course, if it's income, it may not be the play.
Okay, so in your view, when you're qualifying clients to outsource to these people that are in your consortium, you're looking for reason. They have to pass the risk tolerance test. And by the way, if you're watching our show and say, see, if I've never even done a test. If you're in a 401k plan, you need to do a test.
Yeah.
If you have money, non-qualified money, you need to do a test. And I say, things change in your life. You get older, things happen to your life. You need to take once a year. It's going to take you 10, 15 minutes. Most of these I wouldn't call it science, but it's good psychonomics. Kind of gets you in the game. It's a profiling. You're profiling yourself. You're actually setting a financial profile for yourself.
Yeah.
So you can kind of get an idea. I've noticed on ETFs, especially August of 2015, we had a really market bath back then. And during August, everybody finally saw a little bit of the vulnerability of ETFs. Hey, we're publicly trading this every single moment on the hour. It's not a mutual fund. At the end of the day, we settle up under the net asset value. Oh my gosh, we're buying and selling throughout the day. And that was a first time we saw, oh, look at the vulnerability. We'd never seen ETFs have to look at that. So just keep in mind, it's liquid and it's being traded every day, and it has the same propensity to go up, but it also has the same propensity to go down.
Yeah, just to be clear, mutual funds and ETFs, there's no better safety or higher risk. They're all equally the same. It just depends on how you invest the funds.
Yeah, and I that's a very good statement to make, especially on a consumer show like this, because we're not trying to say we're trying to say the expenses might be cheaper with ETFs. You might even do better in the indices than most people. Can't pick their own stocks and beat those indices. But the biggest issue is they're all exposed to risk. And so you just got to understand, take the risk tolerance test, find out if you feel good about it. Now, when you're sending people over there, you're still meeting with these people, even though you're not really performing the oversight on the funds themselves. You're still performing the oversight on the overall retirement program.
Correct.
So talk a little bit about your quarterbacking in that regard.
Yeah, so naturally, not being securities licensed, there's only so much I can and cannot say, right?
Sure.
But the biggest concern naturally is that we understand that most people need to be in the stock market with some of those monies. And so really carving out what portion that is by doing those tests and getting a better understanding of what's important, then we can actually flip that over and give that to our team.
Well, the thing I like about this is your team over on the security side, this is all they do. They're in it morning and night. They're listen, we're out here, we're recording in Phoenix, which right now is on Pacific time. These guys are up at the crack of dawn on East Coast time because the market opens at 5:30 or no, 6:30 our time right now. So think about it. That's the kind of dedication we're looking for. Don't forget to watch our next segment on planning for assisted living and elder care, part 5 of our series on building a firm financial foundation for retirement. And keep in mind, before moving forward with any of the ideas on our show, always check with your tax consultant, legal counsel, or financial advisor. You've been watching Steve Savant's Money, the name of the game.